Hello everyone, Dividend Enjoyer here. Today I'm going to be talking about my $25,872.52 dividend portfolio. I'm going to be going through my Chase account, which is my more managed account where I actually add money and invest more into different things on a weekly or monthly basis. And then I'm going to go through my Webull account, which is an account basically that's the result of my gains from prior trading that I just kept invested into that brokerage. So it just has a lot of very high dividend stocks that just pay me dividends, and I just take the dividends. I don't really trade this stock. I don't think about it. It's kind of just a thing that's there to pay me for the rest of my life. Whereas the Chase account is more of I could sell this. I probably would sell the Webull account first if I just needed the cash. But this is the account that I'm actually adding to, and this is the account that I'm trying to grow into something much bigger. The Webull account, I could care less what the actual value was as long as I was getting my dividend payments, but I've already made my money there. Here you're seeing the Chase account, and it's worth $18,206.79. So it's worth a pretty significant amount compared to the total. I'm currently down on an open basis, $1,476.78, and this account currently makes me $553.56 a year in annual dividend income. And this does increase because a lot of the companies increase their own dividends. This is a compound annual growth rate of a dividend, and most stocks increase the amount that they pay you every single year. So it is definitely a good metric when you're looking at companies if that's something that's important to you to get passive income. But starting off with the lowest value investment, I have TXRH, or Texas Roadhouse. And I really think that these types of casual dining chain restaurants are going to become bigger and bigger because they offer a lot more value than I think fast food does. And people kind of prefer that. Texas Roadhouse is just great. I think the food's really good. And I also think from a DCF model standpoint, they have a lot of room to grow and that they're going to be able to continue to put more Texas Roadhouse locations all across the country. Next, we have Prologis, ticker symbol PLD. Not a lot to talk about on this stock. It's just a real estate investment trust of warehouse logistics. So it basically owns a bunch of warehouse logistics space real estate, and they rent it out to different people. And I think that that's going to be more high demand in the future. And I also think this has a very good dividend yield for the cost of what it is right now. And I think that once the economy improves, this is going to be worth a lot more. And if interest rates lower, they're going to be able to refinance everything for lower. Overall, I think that this is just a strong company. Next up, we have Meta, ticker symbol Meta. I saw that there was an antitrust lawsuit that was going to be hit by Meta. I'm hoping they get through it, but I still think that this is a very strong company on a DCF model perspective, but it is a little bit mature. But they do have a monopoly on social media, so I think it's very strong. I think I should be adding more here because it's down by such a significant margin. It really does look very undervalued in my opinion. I think that this is going to be the next thing that I probably add more to or more sales force. But Meta's just been really hit bad, hasn't it? Wow. I mean, I remember when it was at 700. So I think that this might be a good entry point into Meta because it just looks really bad for them. But I think they're going to keep delivering good results, and I think that they're going to fight like hell to get what they want. Never underestimate Zuckerberg for sure. Then next up, we have Waste Management, which I just made a video about. I think that it's overvalued for the amount of revenue that it can generate, but I do think that it is a wonderful business, and I do not want to sell any of the shares that I've acquired. So I'm very happy with this stock. Obviously, it's the only one other than Vici that I'm up in. I'm up 11.49%. Which is significantly better than anything else in this portfolio. Yeah, I mean, this is a very just defensive, extremely strong company that was a very smart investment, and I should have put all of my money into this while we had such a big bull market. I mean, this was a really smart stock to get into when everything's going really well. Like if your tech stocks all shoot up and you're up a ton on them, sell out half so then you get your initial investment back. Like if you've been invested for 3 years or whatever, and then just put that half into waste management. And yeah, you're probably going to get slower growth, but if there's a big downturn like this, you're going to retain all of that value and it's going to continue to grow. So I think that's a really legitimate thing that you could do with waste management. Now, obviously, it's kind of the end of that cycle, so you're not going to be able to buy into waste management where you want to. I think you got to buy into tech stocks right now and then hold out on them because they're going to go back up into their value. And then once they just double, triple, whatever it is, it'll take a few years, but you got to find one that really is undervalued for where it should be. If you get one of the right ones and you can double your money over like a 2 or 3 or 4 year span because they've been hit so hard, I think that you should get into those right now. I think that's what I'm looking to do with like Salesforce and Amazon and all these. And then once they shoot back up to where they were pre-crash, then you can sell out of half to get whatever half of your money is and then put it back into something safe like a waste management, because it's probably not going to move very much in valuation. But yeah, I think if my portfolio bounces back way higher and a lot of the things that I was buying for dirt cheap now are worth a lot more, I'm going to sell out a decent bit and buy more waste management with that. So that's kind of the plan there. I think it's smart to trim out of things that are very high growth after they've run and then get into more defensive things. So then, you're just more protected in terms of your value. But yeah, that was a crazy side tangent. I hope that was coherent. Except we have Energy Transfer, ticker symbol ET. Now, this is a pipeline infrastructure company. They control a lot of different pipelines for natural gas and things of that nature. And they essentially charge a tax for moving that natural gas through their pipes. This is obviously a very inflation-proof business because whatever you pay for the pipelines is what you pay for them. There's a lot of concerns about this company for the Canada tariffs because I believe they do have pipelines that go into Canada. I'm not 100% sure on that. But my overall thesis for Energy Transfer was that there's going to be an increased demand for energy in the future, so it makes sense that this is going to grow and make more money because if there's more demand, they can charge more. Then next up, at American Express, ticker symbol AXP, I'm down 7.51%. This posted good earnings. I think that it's very undervalued for what it is. I think this is the safest bet. That's why I've put more money into it. This is a company that I would love to own forever. And this is a company that I hope to be able to own forever and never have to sell out of. I just want to be able to collect that dividend in the future and just live off of American Express stock. Because it's just such a strong company. And I don't know. I think for what it is, it's grossly undervalued right now. And I am not a financial advisor, and that none of this is financial advice, but I really think that American Express is very solid. It's shown that it can make its earnings and it can continue to grow year after year after year. It's grown basically consistently every single year with like 1 or 2 outlier years. And if you have a company like that continuously does it as it's mature, that is a really just amazing company to be involved with. Next up, we have Amazon, ticker symbol AMZN. This is down 17.17%. I've bought more of this because I think it's also just a very strong business. I love that they take a lot of risks to grow the free cash flow. And I think that out of all of the, big tech companies, I think that Amazon is going to be the strongest into the future because of AWS and just because of how proactive they are with new information and with developing things and with how strategic they are as a company. I think that they're an amazing once-in-a-lifetime type of company. And I would always bet on Amazon being able to do well and being able to perform. I think that this may be the highest growth stock that I invest in, and everyone's going to look back and be like, whoa, I mean, Amazon really was able to turn into something that has just evolved the way we live. Next up, I have Salesforce, ticker symbol CRM. This is the one I'm down the most on, 20.55%. I think that this is being very undervalued as well for what it is. This is an ecosystem that grows consistently every single year without much money being put into the growth, while they're also putting money into developing new things that can just make all of the products as a whole better. I think that this could be revolutionary in displacing a lot of the jobs that have been offshored to AI. I think that that's something that they've kind of quietly created for businesses so that if they don't want to have their call centers overseas, they can use the agents to be able to hire less people overseas. So I think Salesforce is going to be revolutionary in a lot of different customer interfacing things as well. And overall, I just think that Salesforce is a very strong business with a very smart CEO. And I think that they're going to be able to navigate through this and make a lot more money into the future. And I think that what you're paying for with Salesforce is a little bit of a premium on a business that has a lot of growth going for it into the future. And I'm going to be continuing to buy more. And finally, for the Chase account to kind of round it out is a Vici stock, ticker symbol Vici. Obviously, I'm up 3.2% on this, but that's misleading because it's not counting the dividends reinvested. I'm up about $312 on this, with if you include the dividends being reinvested. Yeah, I really love this company. It's a triple net real estate investment trust as well, kind of like Prologis, so they don't pay any of the actual maintenance or taxes or anything on the buildings that they own, and they own casinos on the Vegas Strip. So this has kind of allowed me to own the real estate of the Las Vegas Strip without having the risk of any of the gambling or anything like that. This company just owns the physical buildings. They do not own the rights to run any of the casino part of it. So as long as the casinos can pay their rent, which I think is very likely, this company will continue to be able to grow. When they get their rent money, 75% of that goes back to the shareholders, which I like. But then that 25% of net income goes into finding new properties that they can buy that can increase the amount that's coming back to us shareholders. So over time, there's a lot of growth here. And with lower interest rates, this is going to be worth a lot more money. And I think that they're going to be able to continue to grow the dividend too, because I think that this is a great dividend payment that I'm getting from this stock in particular, and I'm very happy that I'm invested in Vici. Next up, we have the Webull account. I have about 7,600 in here, and I have a ton of Energy Transfer, which pays me $106.60 four times a year. So I'm very happy with that. I've got some Microsoft shares in here as well, and I have some DraftKings shares. And the Microsoft shares pay me another like $20 a year in dividends or something. I just want to hold some Microsoft just in case. And these are the first stocks I would liquidate if I needed to sell off something or I needed the money. But other than that, I really don't look at these stocks very often, and I just kind of, pocket the dividends and don't really touch them. So, yeah, that's my full kind of portfolio. I haven't been watching as much news this week just because I feel like it's kind of depressing. And, I don't know. I just wasn't watching it as much this week, and I didn't invest anything new into the account. I just kind of was letting everything ride, just kind of watching passively. But overall, I think that I'm going to build up some more cash so that I can just kind of see what's going to happen and then decide if I want to deploy it or not. But I'm just kind of sitting loose and holding what I have and, really just thinking about the deals before I pull the trigger on anything, because I think that it's definitely a more risky time, and I kind of want to see a clear winner and then invest in that clear winner, if that makes sense. But I don't know. I think it's tricky, and I think we'll figure out what is meant to happen. I'm not selling out anything. I'm not panicking at all, but I'm just being patient, and I'm saving up some more money just because I want to have more cash on hand, you know? But let me know what you guys think. Let me know if you guys like this week's video. If you didn't like this week's video, if you wanted me to go more in depth, if you thought I went, too off depth, or if you guys want, shorter stuff like this, it's more concise to the point, or if you want more long drawn out kind of content for this video. So yeah, let me know what you guys think. Thank you for watching. Bye.